So far, so good.
Good stuff. Good stuff. Thanks a lot for coming on.
No, it's great. I'm glad to be on.
Yeah, it's great to have you here. You're actually the first Forex trader I've had on the show.
Ah, very exciting.
Yeah. So I've actually had a few listeners who have sort of reached out and say they'd like me to interview a few Forex traders in the mix. So here we are.
Yeah, that's exciting. I mean, Ryan, who I guess reached out to you, had heard some of your stuff and he was excited about trying to get us to connect. So I'm very glad to be the first FX trader. And have you had any exposure to the space a little bit or?
Yeah, so I mean, Forex is definitely not my playing field. I've never taken a foreign exchange trade.
Yeah.
So my knowledge in the field is a little bit limited.
Yeah.
So what I did this morning is I posted a tweet and I said to if anybody had any questions that they wanted answered around, Forex because you were coming on the show.
Yeah.
And we got a pretty good response. So we'll be sure to run through those.
Sounds good.
All right. Well, let's get this underway by taking us back to the very beginning of your career. So we're keen to hear how you got started.
So I guess I had a bit of an unconventional start into the market. I sort of, I was going way back to my college years. I had, I'm always surprised. I don't know where you were at, but I'm always surprised at how so many people have such a very strong idea of, their direction out of university or college, and they know exactly what they're going to do. I had no idea what I was going to do, and so I defaulted to going to law school, and I had no intention of practicing law. I realized that very early on. Most lawyers realize that after a couple of years of practicing. I knew right away I didn't want to practice, but it was a few years to get a little bit of experience. And then out of law school, I went into investment banking. I sort of got introduced to the world of finance, and I thought that this was an exciting thing, not knowing much about it. I was a history major in college, and I went to law school, but I started out in investment banking, working in an area called debt capital markets. And then when I was in banking, I got exposed to the different areas of banking, and one of those areas was, I remember one day I was working on a floor in the bank, working in this debt capital markets group, sort of behind the scenes, preparing deals, putting together books, and going out and trying to raise money for companies that needed loans to do deals. And I had to go downstairs to another floor, and this was the trading floor. And I was like, why am I not down here? I mean, this is a lot more exciting. I mean, what the heck am I doing upstairs on this other floor? And so that was my introduction to the trading floor. And then I was exposed to the different groups, and I was just immediately intrigued to the FX desk and all that it had to offer, and the fact that it was exposed to this global macro desk that was gave you exposure to different countries and the politics of different countries, the economies of different countries, and I just found it to be fascinating. So that's kind of how I got into FX, and from there it was just off to the races.
Okay, so were you actually trading while you were working in investment banking?
Yeah, so I was working in investment banking, and then when I transitioned to an FX, it was not in a trading capacity. It was in a research and strategy capacity, and so my career, the breadth of my career, and a good portion of my career then was devoted to working on the FX currency research and strategy side. Before then, years later, getting into the trading.
Okay, right. So at what sort of point did you decide to leave those firms and become a full-time trader, sort of playing with your own money? And what was sort of your motive behind that?
Well, I was always attracted to, I remember, even going back to my elementary school years, I was always attracted to markets and the idea of speculation. So, that was what, got my juices flowing. And so when I was exposed to the FX desk and to this market, I was drawn to the idea of being able to speculate on markets that I knew that were very difficult, and that probably one of the toughest things to do out there was trying to beat the market over time. And so I was drawn to that. So when I got pulled into this market and into the world of trading, it was always because I had this idea of wanting to go off on my own. I knew that this was a very lucrative career, or could be, and there was intense challenge I'd come up in sports, and so I think that athletes find a lot of similarities between trading and sports, and so I wanted to sort of get to that point. But I knew that to jump right in for me, at that time wasn't going to make sense. I wanted to sort of learn about the market a little bit and cover the market and sort of be able to sort of figure out who I was and what my methodologies and strategies were and what made sense to me, because we could talk about this, but a lot of your trading is a reflective of your approach to trading should be reflective of your personality as a trader. So a strategy that might be good for me, I for example have developed a more of a counter trend type of a trading approach, and then that's maybe good for my personality, as I'm a bit more of a contrarian in life, and I sort of like to go against the grain. And so you need to find strategies that complement your personality. And so that's basically was a path for me to find out who I was before taking that saying, okay, now I'm ready to get out there and put some real money to work.
Yeah, okay. No, that's really good. So when you did make that transition, did you find it easier or harder than what you had sort of originally anticipated to trade your own money?
I think that's a great question. I think that there's no way that I'm going to stand here and tell you that once you jump into that water that maybe there are certain areas where I think it helped me a little bit, but you're never going to really learn or feel what it's like to be a trader until you actually step into those shoes. So while I did have experience and an understanding of the market, as far as trading was concerned, you really only learn once you get your feet wet. And so when I stepped in, there was still a nice learning curve before finding my stride.
Yeah, okay. I'm keen to hear about that learning curve. So what would you say were some of the difficulties you experienced early on?
I think the difficulty that I experienced early on, that's something that you need to figure out quickly or sooner than later, that just surprisingly takes so long. It's with trading, it's the thing about trading is that it's we make it more complicated than it is, and some of those things are just we have this built-in sense of wanting to be right. Intuitively we want to be right, and especially maybe coming from the strategy side, you get into the market and you have an idea, and you want that idea, you believe in that idea, and you take the position, and you're committed to that idea. And so sometimes your stubbornness and inability to sort of understand that being wrong is a part of it is a tremendous obstacle, and it can be destructive. And so that's something that you really need to get your ego in check. And with trading, it's always this big paradox, because to trade you need to have a tremendous amount of self-confidence, and you need to be able to be decisive and make decisions and almost have an arrogance about your opinion. But at the same time, you have to have a humility and be able to say, okay, this is not working out, I'm wrong, I need to move on to the next one. And so these are things that I'm sure you've discussed with a lot of other traders that you've met, but the idea of sort of understanding how to take a loss is just there's nothing. I'd say that's the biggest first step of getting on your way to trading is knowing how to take a loss. And for some reason, and just because of our nature, it takes a lot longer for us to for people to get over that. I don't know if you've heard this, but intuitively, traders are fearful in a winning position, and they're hopeful in a losing position. This is the way that we're built in. This is how we're wired. So if a position is going in our favor, right, we're fearful. We see the money and we want to take it. And if a position is going against us for some reason, the way we're wired, we're hopeful. We want that position to work out, and so it goes against us and it goes against us, and inevitably, that leads to a path of disaster. And so, what you need to do as a trader is you need to be able to flip that around. You need to be hopeful in a winning position and fearful in a losing position, so that you see a position going your way. You don't want to take the money off the table. You want to let the position run. And if a position is going against, you need to be fearful. You need to say, I need to protect my capital and preserve my capital at all costs. And so these are things that for many people take a lot of time. And the funny thing is that, so many people spend too much time, reading books and focusing on strategies, and really these are the obstacles that need to be, you need to be handled first. And if you overcome these, then you're, 90% of the way there.
Yeah. So that's sort of borderline on the psychology of trading, which I'm really keen to get into that a little bit more with you later in the interview. So I think you have some good points to share on that. But how long would you say it was before you sort of found yourself to be consistently profitable with your trading?
Well, for me, it took many years. I mean, I would say, for me, it took, I'd say, 5 to 6 years before I was, feeling comfortable, with my trading, and a lot of that had to do with, developing a methodology that made sense, an approach to market that made sense, and just sort of fine tuning my strategy and what I was comfortable with, and getting to know the markets that I was looking at. So it took me, I'd say, about, there were a couple of years where, I struggled. And I'd say, into my third year, things started to come together a little bit, and then by, I guess, 5 years out for me, was when I started to, I guess, start to really feel like I was, you never want to be too comfortable. That's for sure. And I don't want to say that I'm comfortable to this day, because, the market will knock anybody down. But, I guess as comfortable as I can be at this point, it's into my fifth year, I'd say. For some reason, people feel like they can jump into trading and be making money within a couple of months. But people need to understand that, this requires a tremendous amount of commitment and devotion, like any other, profession that you're going to, that you want to be involved in, and that you need to be. Then it requires the same amount of passion and interest. And so these things, you're never going to jump into, you don't jump in and you're not performing surgery on the first day you go to medical school. And so these things take time, like anything else. And people need to understand that. And it's a process. And if you have the passion and you're committed to it, then you'll get there. But it takes time, like anything else. And people seem to forget that, given the instant gratification part of the business. But, it's something that shouldn't be overlooked.
That's a really valid point. So thanks for adding that in. I mean, I agree with you 100% on that. So let's run through some of these questions from the listeners. So we've got one here, and that's from John. And he says, were you successful in equities or futures? So I think what he's asking here is, had you traded in other markets before actually zooming in on Forex? And did you see any success in these areas?
I had not. My first exposure outside of, a retirement fund and trading, in that capacity, which wasn't really trading, it was just, sort of long-term investing. My first exposure to the world of trading was through the FX market. And, for me, that was where, I'd come from a background where I didn't come from a finance background. And so the first market that I got my hands on was where my focus was. So there was no experience on the equity side for me, or on the commodity side, was right into the world of FX.
Yeah, right. Okay, cool. So he's got another question here, and that is, I think this is a really good one. So in your view, what are the different dynamics and forces that separate FX markets from other instruments?
That's a good question. And so FX is, I love FX, and you learn to discover this as you get into the market. The beautiful thing about FX from a trading standpoint is that there's no bigger market in the world. And so when you want to trade a market, you're looking for two major things when you're trading a market. You want to see liquidity and you want to see volatility. So you want to see the market is deep, and you want to see that it moves quite a bit. And so these are two things that a large market is going to give you. And so FX is the largest market in the world. And so when you're trading it, it gives you certain advantages of, for example, you look at In other markets, you get gapping. So a market will, close at a certain, time one day and then open up at a different time the next day. And whenever it opens, and you see there's a large gap in the price. In equities, you have earnings and things that come out pre-market. And so, with those types of trades, when you're trading those markets, there's a lot more of that. So there's a lot more of sort of, I'm in a position, but I'm stressing overnight because the market's closed about, what's going to happen, earnings. And, with FX, the market that never closes. So, you open in Asia or New Zealand, you open up on Sunday and the market closes on the New York close on Friday. And so, you're always there. You always can see what's going on. The market's always trading. And so even though you have these events that are coming up that can, inspire volatility, the market is so deep that you're not getting these, penny stock like moves, and you're able to be there ahead of it. And, the other great thing about FX that I find, extremely attractive is how accessible it is and how available it is at all times. So it's a fantastic market in that you can be anywhere in the world. And basically from the same hours, if you want to, work from 8 a.m. to 5 p.m., well, you can do that anywhere in the world and trade FX. Obviously you're trading different markets depending on where you are in the world, but, no matter where you are and what you're doing, you always, can sort of, provided it's not the weekend or Christmas or New Year's, you're always, you're looking at the market. So I think those are the key standouts for me.
Okay. No, that's really well said. So those were sort of mainly benefits in the favor of Forex. Would you say there are any disadvantages to it?
Yeah, I mean, one of the biggest disadvantages is really not a function of FX. The biggest disadvantage is more regulation side, and so FX or Forex gets a bad name. Not because of the market itself. People get confused. It's more because of the lack of regulation in the market and the amount of leverage that retail traders are given and are afforded. And that's a big problem because when you ask somebody to step into a game where they have no experience and they need to put so little up on the table and they're basically margining all that up, and they're using they're 100 to 1 or 200 to 1, or even people are crazy that brokerages have had to now come down to 50 to 1, but that's crazy. And so if I give you $10,000 to trade and you're taking $1 million position, one move in the market is going to wipe out your account. So that's not reflective, or it's not a function of the FX market, but it's a function of the leverage that's afforded to the trader. And that's been the killer, and that's been what's caused so many problems. It's brokers taking advantage of and preying on the new trader that comes in that doesn't know what he's doing, that wants to, a lot of them are misguided and they just want to they think they have that casino mentality, and the leverage lets them take advantage of that. If I told you that FX now only had maximum 3 to 1 or 4 to 1 leverage, well, it wouldn't be the same market, it wouldn't have the same attention, and it would be no different than any other market. You'd be putting your position down. You take a $100,000 position and you'd have to put up $100,000 or $50,000 to trade that position. And so a movement of 1 or 2% really means 1 or 2% of your entire equity. So you take a $100,000 position, you put $100,000 up like you would in the stock market, and the market goes against you 1% and you lose $1,000. So, that's the biggest problem is the leverage. So if traders could just, I can't stress enough, the biggest, thing that I can recommend anybody that's listening, that's starting out, is instead of taking 10 years to keep blowing up and trying to figure this out, or taking 1 year to blow up your entire account and walk away, take 6 months or a year and trade your account unleveraged. So whatever you put into that account, if you put $10,000 into the account, your position sizes should be $10,000 position sizes, so that if the market moves against you 1 or 2%, that's how much of your equity you're losing. And if you do that, then you'll be way ahead of the game.
Yeah, those are really valid points. So we've got another question here, and that came through from Brad, and he's asking, what timeframes are you working on? And how do you handle high volatility around news? So pretty much two separate questions there.
All right. So the first question, the time frame. So I consider myself to be a short-term trader, but I'm certainly not a high-frequency trader. I'm short-term in the sense that I'll take a couple of positions a week, and I'll sort of sit on them. I tend to focus in on really the four major time frames for me are hourly, daily, weekly, and monthly. I don't generally look at anything shorter time frame than hourly. And for my positions, I tend to sort of start with the bigger picture. So I'll look at a monthly and a weekly and a daily chart, and I'll try to get the bigger picture to determine what my views are. And I also like to I consider myself to be techno fundamental. So I try to sort of look at everything and sort of have a fundamental view. So if I feel that right now the euro has broken to a fresh 11-year low against the dollar, trading down below 110. I feel fundamentally, clearly the trend fundamentally has been in the dollar's favor, given the Fed's, impending rate rise and the differentials between the central banks, between the Fed and the rest of the world. Fundamentally, the dollar's been benefiting tremendously. But maybe fundamentally, I believe that, today's employment report out of the U.S. there's a risk that it might, come in lower than expected. So maybe I believe that maybe there's a risk for the dollar to come off. So that sort of starts there. And I look at the chart and I see that the euro is dramatically overextended on the monthly chart and on the weekly chart and on the daily chart. So now I understand this big picture. And then now intraday, I start to look at the hourly chart. And once I see the hourly chart is sort of looking at a point where, I feel there's a good entry. So I try to isolate my entries based on the short time frame, but I formulate my ideas on the larger time frames. I don't tend to look at anything below an hourly chart or shorter time frame than an hourly chart.
Okay. How do you handle high volatility around news?
So with this, I would recommend, personally, I think whatever you do, you need to be consistent. So people always ask me these questions. Do I trade around news? Do I not trade around news? If you have a strategy that is sort of, purely technical, but you have to deal with these things, then I think the best thing to do is to sort of commit one way or the other. You say, okay, there's a big news event today, and I have this strategy that tells me to buy, and I don't know what to do because, there's this news event. I think you need to decide whether you're going to, not trade around large news events or you are going to, and then just let it be. And so if you're, as long as you're consistent, you'll again, it goes back to psychology. You need to make sure that your head is on right. So if you're consistent, now you'll know that you'll benefit just as much from the strategy in those times as you will not benefit from it, but at least you'll know that that you sort of eliminated that doubt in your mind. I personally don't. I'll trade at any time, with exception, of course. But I actually welcome the volatility from the fundamental event risk. I welcome it because it's just an opportunity to sort of act as a trigger for the trade that I'm expecting. So if technically I think there's going to be a rebound in the euro today, maybe I'm excited about the non-farm payroll number in the U.S. because that could be that spark that gets that volatility going. So for me, I trade no matter what, but my recommendation to the fellow who asks is just to try and be consistent. So if you want to trade news, if you want to trade around news, or then be consistent and always trade around news, and if not, then don't.
Okay, that's really great. So yeah, thanks for sharing on that. And another question here came in from Glenn, and he's asking more specifically around what do you look at for entries and exits?
Okay, so for me, I use so exits is the hardest part for traders to exit when you say stop loss, I'm assuming, is the hardest part for a trader to initially overcome and to get over it, being able to take a loss. But it's so easy to do. So from strategically, it's very easy to say, okay, I'm looking at this market, and if it doesn't work out, I'm going to get out here. That's very easy to do. And so taking a loss or understanding that, if I lose more than 1% of my equity or whatever it is that you do, that's the easy part. The hard part is and I'm still learning to this day, is the risk management once you're making money in a trade. But specifically, I use two indicators as a contrarian. I like to use two indicators. One is called RSI, Relative Strength Index, which is well known across all markets, which gauges how the market's performing relative to recent price action, and it's an oscillator, which basically means that the indicator as it goes from 0 to 100. Anything when the indicator is showing above 70 is considered to be technically overbought, while the indicator shows below 30 is considered to be technically oversold. So that's sort of a starting point for me. So I'll only look at markets really. I go well on both extremes. I go well above 70. I look at only and well below 30. But that's where I start to look for entries. Sort of when an RSI shows that the market's deviating from its mean, and the market's sort of moving a little bit out of control. That's when I first sort of get that light goes on. I also use something called ATR, which is average true range. It's an indicator that many know, but a lot don't, and it's for some reason it's not used as much. And I think it's a very easy to use indicator, simple. There's nothing to it, and it's so valuable. And it basically just tells you, based on the last several days, what the average range of the market you're looking at what the average range of the market that you're looking at is. So if for the euro, if it's 100 points a day or 100 pips, that's the average range a day. So when you're in the middle of it, and if something's going on, and the market shoots up 100 points, from high to low within the middle of the day, well, you can at least find comfort in the probability that, okay, the market's already now matched its average daily range, so maybe it's not going to move much more. So these are tools that give you, that help give you confidence. And so these two things I use to help with my entries and my exits as well. So for example, I might use an RSI to tell me that the market's oversold. It looks like it's bottoming here, and so I might use that to get in, looking at a high or a low, and I might use that as an entry. And then maybe I'll use the ATR for an exit, knowing that, okay, I got in, now the market's moved to its, its average range high for the day. It's moved within that range, so I'll use that as an idea to exit the position. But generally speaking, from a risk reward standpoint, you always want to be at more than 1-to-1 risk reward. A lot of people will tell you 3-to-1, 4-to-1. It depends on your strategy, but you should always be thinking, I want to make more than I'm risking.
Yeah, no doubt. No doubt.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So, Joel, we've got another question here that's come in, and I think a few people sort of probably share this viewpoint. And this guy says, we know Forex is where fortunes are made, but in most cases lost. In truth, is Forex best left to the pros? What's your take on this one?
My take on this goes right back to that question we talked about when we talked about the disadvantage of FX. It really is nothing to do. It's there's no better market in the world to trade than the FX market. The problem is that when you open up a market to people that are just getting in and you give them excessive leverage, that is why these people are having a hard time. So certainly engage in the FX market. You're not going when you trade, you need liquidity and you need volatility, and these markets are open all the time, and they're efficient, and there's no more efficient market than the FX market. So it's a fantastic market to trade. The problem is that people just get sucked in and they're victim to the leverage, and they don't know what's going on and they don't understand. If you would just make sure that your account ask your broker, or make sure to set your settings at leverage of maximum 5 to 1, then you'll be fine. And you'll find that it's no different than any other market, except for the fact that you might have a little more volatility, which is great, which is, giving you opportunity.
Okay, cool. That's really good. So we'll take one more listener's question, and that's from Phil. And his question's pretty much around, do you have sort of like a daily routine that you follow each day before getting ready for the market?
Yeah. So I tend to follow a routine. I never really left the research side. That's still a part of me, and it's a great part of my process. So I recommend to everybody. I am constantly. I basically get up in the morning. And I scan. I'm not gonna lie. I mean, it's I am constantly watching the market. I find myself getting up in the middle of the night, not because I'm stressed about the market, but just because I'm excited about it. So I have my monitor or next to my bed. Or I have my rates, so I check. But when I get up, I generally take a quick look and see what's going on. And then I start the process of scanning through the markets and looking for where I think there might be opportunities, but not looking to force anything. And then, I have a process of writing. So for me, it's a wonderful process. I try to sort of get out and formulate my ideas, just not necessarily about a trade, but just what I'm thinking that day, how I'm feeling that day, what I think about the market. And it allows me to maybe take on a little bit more of an objective approach, or, it's maybe a bit of a therapeutic process. And it helps me because I find that, one of the big problems with traders is also that traders are too impulsive. And so if you're able to sort of, pen down your ideas or pen down what you're thinking and take it, then it keeps you honest. So for me, it's about, getting, going through that process and sort of, figuring out what it is that I'm thinking and sort of, keeping myself, allowing myself to stick to that. I think that in life in general, when you want to do something, there's no better way of being able to sort of follow through than telling yourself repeatedly that you're going to do that, and reminding yourself repeatedly that you're going to do that, because it becomes you, and you can't prevent that from happening. So if you want to take a trip to Hawaii and this is what you're committed to, then get that picture up, talk about it every day, and the more you do it, the more it sort of becomes a reality. And that's very important in life, as it is in trading. So you need to be able to get that out. So for me, it's about putting things down on paper and writing them. And then the biggest, really, this might be a surprise to a lot of you, but the biggest luxury that you have when you're trading on your own and something that's really necessary, and something that people that are trading professionally at banks and hedge funds don't have, is the ability to walk away. So I'm a lot of the time during the day, I'm completely away from the market. I'm completely removed, and I have my alert set up, which is critical to me. I get them by my phone if something's moving. Otherwise, I just sort of step away, and I look into other things that I'm doing in life. And if the market comes to me, that's great. Then it comes to me. But don't force your positions. Let the market come to you. So a lot of the day is just going around, going for a run, doing some shopping, looking at other things. I do some consulting work, and waiting for the market to come to me. And so that's pretty much it. I mean, as far as my routine is concerned.
That's really cool. So let's now's probably a good point to sort of roll into a bit more on the psychology of trading. And I believe you recently spoke with I hope I pronounced this right, a psychotherapist, about how to reduce trading stress. So, what were some of the best pointers you took away from this?
Yeah, I mean, I think that again, there's nothing more important than psychology as far when you're trading. So again, I can't stress enough. I find that too many people focus in on going out and buying books on what strategies to take and what risk management they should apply, without really understanding that intuitively, if you just look at a chart and you sort of pick out, what you think is going to go on. Just start like that, and don't worry as much about that side. I'm not saying that that's not important, but you need to have a sound mind, and you need to have a healthy mind. And if you feel good about yourself and you feel confident, then that is what's going to help you along the way. And so that's the most important thing. And so some of the takeaways, from this were just, there's a lot of this, when you're trading, unfortunately, a lot of what trading brings is, there's this world of, this mentality of, being impulsive and this casino-like mentality where I want to win and I want to make a lot of money. And so you need to figure out who you are and what your motivations are when you get into this. And so if your motivations are right and you want to be in this for the long term, and you see that and you realize this is not an overnight thing, that's what's going to help your process. And so I guess the biggest takeaway is really understanding yourself, knowing who you are, and knowing what your limitations are, and what risks there are to your own personality, what things might cause you trouble, and being able to know how to handle those things in life, not in trading, but in life. Knowing that if you're an impulsive person, try to figure out things that might tips that might help you be less impulsive. If you find that you're taking too big risk, well, there's obviously something inherent built into your personality that is making you want to do that, and that extends to the way you are in life. So it's understanding who you are as a person, and trying to have some sort of a mechanism that you set up to sort of explore within and understand how you're going to overcome those setbacks in your personality. And then once you understand, and you have a strategy with that in life, and then you approach the markets, you'll find that it makes a world of difference. So it's really just, figuring out who you are as a person in life, and figuring out what your drawbacks and limitations are, and who you are as a person, and then working on those things and bettering yourself as a person, and then that will help in your trading. So if that helps at all, I hope that makes sense.
Yeah, definitely. That's great. So how do you handle a run of losing trades? And what would you suggest to other traders who might find this hard to deal with?
So the first thing I would ask, and we keep going back to this, is the first thing you need to make sure of is it's a lot easier to swallow a round of losing trades that are with little leverage than it is with a round of losing trades where you're leveraged up at 100 to 1. So that's the first thing. So that's easier said. That just make sure that you're not trading on excessive leverage, because if you're doing that, then 3 or 4 losses is going to be life threatening as far as your trading is concerned, career is concerned, versus 3 or 4 losses where you're unleveraged and taking a 1% hit on each, or 2% hit on each trade. So that's the first thing. The second thing is you need to go, again, this all ties into the psychology of trading. You need to understand that that's a part of the process. You're going to go through periods where you're going to take hits on trades. And so if you understand and you believe and you know that this is a part of the process, that there are these periods, just like if you have a regular job or another job, you're going to have, bad weeks, and that's going to happen. And you're going to go into the office and you're going to have stretches where things are, you're not hitting it. You're not on your game. And that's fine when you're in, another job, which many of you are out there, you know that you have these periods, but you don't get too down. You know that you're having a bad day or a bad week, but also confidently that, things are going to turn around the next week, and you don't even stress about it because that you have that confidence. It's the same thing with trading. I mean, you're going to go through these periods, and you need to be able to be positioned right so that you don't take huge hits on each trade. But other than that, you just understand that that's a part of the process, and I think that helps tremendously with that. Now, I will say one other thing. people try to quantify how they should trade and what strategies they take. There are a couple of rules, or there's one of the best things that I've applied in a qualitative way, not quantitatively, but is just if you just say, I'm going to make sure that I love every trade that I take, love, not like, but love every trade that I take, you'll find that that's an amazing risk management tool, because there's so many trades that you'll take where you just like them. You say, okay, this looks good, I'm going to take it. I kind of want action, and I want to get in. So I like it. So I'm going to take it. And then it doesn't work out. But what happens when you do that is when you take trades that you like, you find that you're taking them a lot more often, right? And you find that when they don't work out, you're kicking yourself. You're saying, oh, why did I take that trade? But if you take a trade that you love, then they come around less frequently, which is great because they still come around a lot. And when they don't work out, okay, when they don't work out, you're not looking back and saying, oh, maybe I shouldn't have taken that. You know that you should have taken the trade and that it just didn't work out because that's the way the markets are. So that's, I think, a very big secret for me. It's helped me a lot in my process where I don't force anything, and I only take trades that I know that if they don't work out, then I'm not going to regret.
Yeah, that's great. I really like that one. And I read this kind of leads into it, and I read this on your site, and I think it would be great if you could expand on it just a little bit. And that was a line that read, failure as a stop on the path to success. So would you like to share with us sort of the importance of understanding this statement?
Yeah. So that comes from, I believe, you're pulling something from one of my favorite quotes. It's from a Bob Dylan song. But basically, the path to success is rooted in failure. And, you need to understand that. And so if anybody, it's like, when you look at the world of, sex and glamour and supermodels, people get this supermodel idea where, right away you look at a supermodel and you're like, this is what my idea of a woman, the perfect woman is. And when you look closer, you realize that that's not a reality, that's not life. That's not the way things are. And so, things don't just happen. There's maybe, the lottery ticket person or the super brilliant person who, hits his stride right away. But, certainly from my point, that didn't happen. And things take time, and there's a lot of failure along the way, and failure in a good way. It's you can't learn without failing. And if you're afraid to fail, then you're not going to be able to succeed. And so this is, and failure, it's such a harsh word, and there should be another word for failure in a positive way, but it's just a part of the process. And if you can't fail, then you're not going to learn where the mistakes are and how to correct them are. And it's so important to be able to go through the process and say, I know that I'm not going to I'm probably not going to succeed right away. And if you have that, then it just, all of a sudden it opens you up to success if you're willing to embrace that. And not only that, but I'd like to think that, the harder you struggle, the more you can sort of look back and say, wow, look what I went through. And you could feel better about your achievements and feel better about yourself as a person, that you worked really hard. I mean, who wants something that's going to come easy in life? It just doesn't, we all say we do, but is there anything to that? I mean, what kind of person are you if things just go your way all the time? You're not interesting. And, you probably develop a pretty, warped perspective of the world around you. It's not fun. I mean, so we need to struggle. And it's certainly been a part of my process and something that I embrace. And you come through so much stronger from the losses than you do the wins. I mean, you come out on, if you can get through that other side of a loss. I know many of you out there have probably traded and you've blown up your account, but that's fine. That's good. That's part of the process. If you can get through that and get up and say, okay, I screwed up and I made a mistake, but that's fine. That was supposed to happen. Then you're going to come out so much stronger.
Yeah, that's a great piece of advice right there. All right, Joel, well, this sort of brings us towards the end of the interview, but it's been awesome having you on. So before we go, we'll just go to the closing bell, which is just a short lot of questions that I ask to all the guests. So the first one would be, is there any piece of advice that has really stuck with you ever since you originally read it or perhaps even heard it?
I think the best piece of advice that I've had over the years is just to keep it simple. I think that, if you keep it simple and you don't overwhelm yourself with people are always asking me about, when should I take profit, when should I get in a position, if I'm 5% within my profit, should I take the profit or should I wait? You need to trust yourself, and you need to keep it simple. And a lot of the problems that traders have are not on anything complicated. They're simple, silly things. So if you keep your strategy simple and you focus on the psychology and just understanding what it is that you have within your capacity, you'll be fine. So just don't try to overcomplicate things. Simplicity is genius, and keep it simple, and you'll be fine.
Okay, great. I like it. Knowing everything you do now, would you have done anything different come day one again?
Ooh, looking back, if I had perhaps, these questions are always difficult because you look at your life and you sort of try to look back and say that this is how I guess I would have if I could do anything differently, I would have not gone to law school, I guess, and just gotten right into the market right away and got maybe a bit of an earlier jump on in trading, but you never know what it is that you're going to do until you figure it out. So I can't feel too bad about that, and maybe just maybe getting in and not wanting to if I could go back, not wanting to sort of feel rushed about needing to succeed. I think that's a big problem for traders that are younger and they're starting out. You feel you need to hit your stride quickly, and maybe because I came over from the strategy side, I felt that I needed to accelerate that process and get there quicker, or I deserved to, and maybe I was trading a little bit more aggressively. So one of the things that and so I was maybe using a little bit more leverage than I should have. So I guess one of the things that I've for my people that I've said over the last couple of years is I posed this something called the unleveraged challenge, which is specifically for FX, given the leverage that people are afforded, is to take 1 year, like I talked about a little bit earlier, take 1 year and forget about making money. Don't focus on the dollars and cents. Focus on the percentages and trying to succeed, and don't worry about the money. And so open up a small account of, a few $1,000s or whatever, even a few $100s you can do. And you need to feel like you have skin in the game, but open up a small account and trade that account unleveraged for 1 year. Give yourself 1 year where you are completely removing yourself from the idea that you're going to hit it out of the park and make a ton of money. Forget about that. Just try and focus on and enjoy the process of trading without the money, worrying about the money and the losses and the wins, and just focusing on, say, if I can trade unleveraged for 1 year and generate 10% returns, or even in my first year, if I can generate positive returns, then I will know that going forward, that if I leverage myself up, because you can in this market, a wonderful thing about FX is that you can leverage yourself up tremendously, that you can scale yourself up, so you don't have to worry about that. So do that for 1 year, and then you'll find that you'll be on your path to success much quicker.
Good one. I'm just going to throw another question in there. And when it all boils down, what would you say motivates you to trade? Would it be, the money, the lifestyle, the freedom? Like, what would you put it down to?
I think if I'm going to be completely honest, at the end of the day, for me, it's the challenge of it. It's the challenge. It's knowing that so many people fail at this, knowing that it's been this impossible obstacle for so many people to overcome, and knowing that the rewards, if you can get it right, are so tremendous. And so that is, I think, what it's just getting up every day and knowing that you're trying to tackle something that is just so difficult for so many people. And it's like I'm never going to be a professional athlete. I never will be. I don't have the build or the skill to be a professional athlete. But with this, I know that if I dedicate myself and I devote myself to, trying to overcome these things that are, again, a lot of them are rooted in psychology. If I can overcome, they're simple, but yet they're so difficult. If I can overcome these things, then I can get to a level just like anybody else out there that's sort of, succeeding in this business. And so the idea that I know that with this, I can reach that highest level, and I have the capability of doing so, and yet it's so difficult and challenging, is probably at the top of the list. Obviously, the lifestyle is tremendous. If you can do it, then having that time to sort of be able to focus on other things and not having a boss above you that is stressing you out about things is tremendous. But at the end of the day, for me, it's just being attracted to that challenge of something, and speculating in something where it's so exciting and it's so difficult, is I guess what draws me the most.
All right, that's great. I mean, Joel, this has been awesome having you on, and I really appreciate you going into so much depth in the answers. It's been really good. So, before we go, do you want to share with listeners where they can find out more about you?
Sure. I mean, if anybody wants to, reach out, I have a blog that I write on every day. It's called JK on FX, JKONFX. Come over and check us out, and all the information's there. And always feel free to reach out to me. I love engaging with traders, and anything I can do to help. I always try to get back to people as soon as I can, and that's another great thing about this market. It's a global market, and probably one of the best parts of my career is when you're trading FX, you meet so many people from around the world, and that's amazing. I mean, you get to meet people from Australia and New Zealand and South Africa and South America and Asia, and so it's just been amazing. So reach out, come over to the blog if you want, and happy to help you in any way I can.
Awesome, I appreciate that, Joel. Are you also on Twitter?
Oh, I am. Yes, I'm at Joel Kruger on Twitter. So feel free to come over and check me out there as well.
Awesome. All right. Well, all those links will be in the show notes at chatwithtraders.com as per usual.
Thanks, Aaron. It's great. It's great. I really appreciated being on, and it was a pleasure.
Not a problem. All right. Thanks a lot, Joel. Let's keep in touch, and we'll speak soon.
Okay. Have a good one out there.
You'll go straight to the page, scroll down the bottom, leave a question in the comments, and Tim will keep an eye on that to sort of answer any questions you might have, especially in regards to options.
Absolutely, and would love to.
All right, awesome. And if you want to check out more, just go to rb-trader.com, and of course those links will be in the show notes as well. So thanks again, Tim, and let's keep in touch, and we'll speak soon.
Appreciate it, Aaron. Take care, and thanks everyone for the time. I really liked doing this the first time and hope to do it again soon.
No doubt. Speak to you soon.
Thank you. Bye-bye now.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it
reach me there. Probably the best way to reach me is to actually just go to leverbrothers.com and just go to the contact us page. Like, I get all the emails that are sent there. I'm on Twitter, but I don't use it that much. So best place to go is just go to leverbrothers.com and contact me through the website.
Awesome. All right. Well, we will put links to your site in the show notes so people can check that out. And again, if you've got any questions, just go chatwithtraders.com/Jason and leave a comment. That'd be awesome. All right. Thanks a lot, Jason. Let's talk soon.
Thanks for having me on, Aaron.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, risking your own.
Coin tasty what you earn. Trade smarter with advanced charting tools.
Of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategy?
Hey, what's up, guys? Welcome back to another episode of Chat with Traders. This is episode 18. This week's guest is a little different to many of the guests I've had on in the past. Instead of giving very little weight to fundamentals and news releases, these two things actually form the foundation for his trading approach. In fact, he almost disregards charts altogether, and he relates the reason for this to his background in accounting and finance. John Welsh has been a full-time trader for over 10 years, and he's racked up millions of dollars in profits along the way. His trading consists of both intraday and swing trading, and he concentrates mainly on biotech stocks, making roughly 90% of his trades within this sector. But now that I've given you the 1,000-foot view on John's trading journey, here he is to fill in the blanks and give us a lot more depth around his approach. Hey John, how you going?
Not too bad. How's your weekend going?
It's good, man. It's good. It's early Monday morning here, and it looks like a busy week ahead. How's your weekend been?
Excellent. Did a nice little race today, half marathon, my best time ever. Things are going well. I can't wait for trading though tomorrow.
Oh, very cool. Very cool. So I'm keen to have you on the show, and I'm excited to have you here. So, thanks a lot for coming on.
Thanks for the invite.
Yeah, no problem. So let's just get this underway and tell us a little bit about how you started trading. How'd you get into it? What was your background? Just give us a bit of an introduction.
Sure. I didn't really like stocks until the market exploded during my college years in the late 1998, 99 period. That was when the dot-com bubble, took off and you couldn't lose any money and anything when stock splits were going up. And I took a lot of risk of investing my MBA checks in the market while I was going to school. And I instantly got hooked because I was making money all the time. And ever since then, I just been feet first into the market. And I've been trading full time now for almost 9 years.
Good stuff. So when you first started getting into trading, where were you learning from? So how did you know what you were doing?
Well, I'm old school and I'm 40. So, there was no Twitter, there was no Facebook, and, there was Yahoo message boards, which I still use today. And I had to learn through my own experience and my accounting and finance background. And I learned a lot about companies, what moves stocks, what people pay for in news and pay up in speculation, and all through my own experience. I don't have any trading tools or level 2 or charts or anything like that. I just do it all from what I see on the screen.
Okay, great. So when you were sort of studying and trying to sort of learn and find your feet in the markets, did you have sort of like a regular routine where you were sort of like you would spend a certain amount of hours a day focusing on trading, or like did you have some sort of schedule around that?
Well, when I was trading part-time and working full-time, it was really hard, and that's what a lot of people in today's markets are trying to do. You have a lot of young traders coming on board trying to make the quick buck by working full-time, and it doesn't really work that way. So basically, for me, when I was trading part-time, I traded a lot in the morning and did research at night. But for the past 10 years, I have the same process that I do every day as a full-time trader. And that is, I wake up at 7 o'clock, I kick up my news wire that I use, which is currently tradethenews.com, and I look for news they're moving stocks that has potential to move during the day, or for swing trades, anything that I think that's important. And I have the same pattern from 7 to 8 a.m. in the pre-market and during regular trading hours. And I never trade in after hours. So basically every day I work from 7 to 4:30.
Okay, good stuff. So let's just talk a little bit more about when you were sort of getting into the market. So what were some of the main things that you struggled with early on, would you say?
I didn't really struggle because in 1999 and 98 is when the markets were going up huge, and I didn't know anything about short selling at the time. So my best stock was AOL, and unfortunately, I had a lot of success in the beginning, and that's what hooked me. And even when the market corrected, when I learned about short selling in the following 2000, 2001, I learned how to go the other way. So you can just say my timing was right, but I have, a lot of tendencies that I think are bad that I've learned within myself that I corrected, and which probably affects a lot of traders, such as overtrading and trading, trying to make up after a big loss.
Okay, cool. So how do you sort of avoid that type of thing from overtrading? Like, do you have sort of some sort of rules you've set for yourself, or how do you go about sort of trying to avoid overtrading?
Well, the two main factors that I see with myself that probably affects a lot of traders is, of course, the overtrading. And I have 10 rules that I developed over almost 10 years ago, since I started trading part-time, that I have taped on my computer and on my desk. And whenever I get new furniture or a new desk or a new monitor, I tape it right up there to remind me that each day is independent of each other. And I learned that through my own experiences, my own shortcomings. Because truthfully, all traders are fucking gamblers. That's what we really are. And that's my shortcoming, that if I ever was addicted to anything, it would be gambling. So in order to rein that in, what I developed is rules that I follow every day, because when I didn't have them, where my shortcomings is when I did a trade for an unexpected loss, I would then follow it up with a bigger forced loss, trying to make back the money. And that's typical of what a gambler does, and from my observation, and that's what I am. So I try to take those feelings out of trading by following my systems, techniques, and rules.
Okay, yeah, and I saw those rules on your site, and I noticed that number 4 was bolded as though like it really is quite important to you, and that was the more stubborn you are, the more you will lose. So would you like to elaborate on why this one is especially important to you?
Because I learned that one the hard way, And, I love talking about, again, my shortcomings, because what I've learned from losing is a system that I can turn into consistent, profitable trades. And with that one is that I used to trade biotech stocks into events. And this was before I became a full-time trader. And, if a stock is trending down and there is an event coming, especially with biotechs, technically the stock is going to do bad because someone may know something, and it doesn't matter how much homework you do, the market is always right. So what I've learned in rule number 4 is don't be stubborn and listen to the market. Is when something goes wrong for me, I immediately sell it. And of course, if you hold overnight and there's bad news and something happens, I still immediately sell the stock. And people don't understand that, and they try to break even on the stock. Well, I save a lot of money by taking my losses quickly, whether I'm wrong on the day or whether it's gapping down on news. You got to listen to the market and get out. And that's what good traders do. They save money by taking their losses quickly.
Yeah, I think those are some really great points you touched on there. So, yeah, really cool. Nowadays, how would you define your sort of trading style? So just tell us a little bit about how you're actually trading sort of right now in today's markets.
It's interesting because it depends. In today's markets, I'm more of a long short trader. And I need to explain why that is, because, for, I would say, the past 5 years, I've been mainly known as a short seller. And I'm pretty keen on, spotting stocks that look like potential red flags or frauds in accounting, and especially biotech. And I have a nose for this stuff. But the thing is, what I've noticed, and if you take last year, I attended a conference that I spoke at, and it was mainly the speakers were short sellers. And there was about 7 to 8 speakers that were short sellers. And I just found it very strange to me that all these people are migrating over to the style that I used to primarily be known for. So what I've been doing in the past 2 years is learning a strategy that's completely different from what I'm known for. People don't understand why, because everybody's making the big dollar short selling. I still do that, but guess what? I think a lot of changes are coming to the short selling industry that people do not expect. And when it occurs, their business could go poof because they did not learn how to do both sides of the trade. So I do long and short, and still I'm slanted 60% short, but I have no problem going long in today's market environment. We're hitting market highs almost every day.
Okay, cool. So you're predominantly day trading, is that right?
I day trade, and I also swing trade, mostly swing trade long positions, and I would only swing trade short positions when I'm up for the day and I carry some over for a couple of days, because I don't like to swing trade shorts as much as I do longs.
Okay, and is that swing trading, is that something that's come through from when you were sort of learning trading when you were still when you were still a part-time trader? Is that something that's come through from there?
I wish, but no. Because 2008, 2009, and 2010, I was so short biased and cleaned up on the market. It was, like taking candy from a baby. And that's, I refined my skills, and I became so, biased to shorting that, I did for I would say between 2010 and 2012, I was still looking for shorts. And then I said, wait a second, we're in the middle of a turnaround here. I need to learn new techniques to go long and to go long on companies that I'm skeptical of. And I've really picked up my game in the last few years by doing that.
Okay, cool. So when you are taking a swing position, how long would you say you typically hold that for?
Could be as high. I usually never hold for more than 3 to 6 months. I like to keep it for a couple of weeks if I could. I've never held a stock for longer than a year. So I would definitely say it's short-term oriented.
When you're in those positions, how do you sort of manage those? Like, what's your sort of trigger to get out of those? Is it based on the news and fundamentals, or are you just sort of trailing stops? How do you manage those trades?
I always enter with a max loss in mind, and my position size is always reflecting in it. So I'll talk about a trade this year that I got killed on, and it was my worst trade of the year. Was a KBIO, which is a biotech that I thought would be a great rebound play for January 2015, because in 2014 it was the worst performing biotechs. And it got halted for data, which was supposed to come out later in the month. And I took a nice 5-digit loss on the trade. And I ended up selling it for like 80 cents or something, and it went down to 40 cents. So, on something like that, I can't manage my loss expectations, but I can sell it quickly to save money. So when something goes wrong and I don't like what's going on with the company, I immediately sell it.
Okay, good point. So you do factor in quite a lot the news and the fundamentals into your trades. That's something you take on board?
That is my entire trading style, is news and fundamentals, because that's how I learned how to trade. And people laugh and say, well, why don't you learn technicals? I just do not like charts. It's not for me. I definitely think with an accounting and finance background, that's much stronger than looking at lines or pictures on a wall that's going in triangles. I don't know. But I also don't use level 2. So I am a pure tape reader.
Okay, that's really cool. So you don't even use technicals for sort of like timing your entries or anything like that?
Nope. If anything, I'll pull up a 5-day chart. If I had to use a chart, it's a 5-day chart, because 90% of my trades are less than 5 days. So if anything, I'd pull up a 5-day chart, but mostly I keep points in my mind and memorize when stocks hit certain levels. Say, for example, for my big short that I'm doing in May, which is CRMD, which is a biotech, I know that the high for the year is 1040 without even looking at the chart. I mean, I have a keen mind for memorization, and I train my mind for certain things to look for and filter out the noise. So if I'm shorting this stock for next month and it broke over that level, I would instantly be out of it. So that's how I try to control my thinking.
Okay, and where are you pulling that level from? Is that a certain like resistance level?
That's just a 52-week high of where it hit in April. Okay. I believe the shares closed at 860-ish on Friday, and that level, I don't need to look at a chart. I know from watching it, and this is one of the stocks that I heavily watch for last month, that 1040 is a 52-week high. In fact, I should probably check it, but I'm pretty sure that is.
So you've mentioned biotech sort of a few times throughout the interview. Is that sort of a sector that you really like to specialize in? And is that sort of the way you like to trade, by specializing in certain sectors and then sort of ignoring the rest that are out there?
Yeah, I love to concentrate on the biotech sector, probably about 80 to 90% of my trades, because it's pretty simple. The biotechs can be valued at whatever they want to be valued, because they're trading at potential future dollar amounts of income that may never come from FDA sponsored trials. So there's so much room for wiggle room. And plus, there's so many shady, garbage CEOs in the business that it's just too easy to short these things and pick them off. And it's also what I've learned in the past few years. It's a good way to go long biotechs that you think that are shady and corrupt because they want to pump their stock price up. So it's been a great learning experience in biotech, and I love focusing on them because I love price, I love beta and volatility, but I also like to manage my risk. So that's why we seem to repeating it, but whenever a stock goes against me, especially in a day trade, more importantly, if the news isn't what I think it should be, I sell immediately because I can always buy it back. People need to understand you do not need to break even on a trade. You could sell for a loss.
Okay. And so if you're relying on the news so heavily, is there certain news topics that, like, how do you determine what news is going to impact the market and what's just sort of not going to impact the market, I guess you could say?
It's hard to determine that, but mainly what I do is, usually my news service spits out the headline. I'll immediately go to the press release and I'll start digging through the details of what they're saying, because a lot of times the headline looks a lot better than what the detail is. And if I think I have something in the detail that the market doesn't know, I'll take a big position size in it and let the market know what it is. I have a large Twitter following. So if I find something that I think that the market doesn't know, I put it out there. So yes, I react to news basically as quick as I possibly can and do research on it.
Okay. And are there certain sources that are probably more reliable than others?
I love the Yahoo message boards. I know I seem like a broken record, but I'm old school, and I still think they have a lot of value. Twitter is a good source for information. I don't particularly like to interact with many people on Twitter because it could distract you. But for quality people and followers, I mean, you can get good information from Twitter, instant information from Twitter that analyze news just as fast as me. So, and it's free too if you follow the right people.
Yeah, awesome. Great tips there. So let's move this along a little bit and let's start talking a little bit about the mental aspect of trading, because we were talking a little bit off air and, this was one of the topics we were going to bring up because I think you've got a lot of good tips to share on it. So what's the best way you find to keep your emotions in check during the trading day? And even outside of hours too, like let's talk about that a little bit.
Well, the thing is, being at it for as long as I have been, I would definitely say that what I've learned is never to overact to a gain or a loss. And people don't really understand that. But, if you have a gain, you can't be jumping up and down, yelling, fucking booyah, something exploded, take a look at me. It doesn't work. And that's what everybody does in today's environment. That's definitely not my style. What I like to do is point out and yell about my losses, because from those losses, I then get to quietly start accumulating my gains. So, mentally, I do not react to a loss or a gain in any way, shape, or form. I completely strip it out. Stock symbols, I don't fall in love with any stock. Simply put, if something's going against me, I sell it. And if something is winning, I move my stop to entry and I let it go. That's it. I mean, it sounds easy, but you would be surprised how many people cannot follow those two steps.
Yeah, that's really cool. So this is something else I wanted to ask you about also, and that's like, when trading, how do you keep a healthy balance between being confident without being over cocky?
Well, that's the thing, and this ties in directly to, the mental aspect of trading, which never gets enough attention in my eyes, which to me, the mental aspect of trading is 90% of trading. And let me explain. Like, I know a lot of successful traders out there, a lot of traders that have made millions of dollars in the stock market. But let me tell you, they do not make a trade unless they check in with my opinion first. And that may seem like a bold statement, but people need to understand that no one knows anything. And people in general are insecure, and they always want a confirmation and support from groups. And that's how the mental aspect of these stocks, of stock trading works, and that's why my style works, is it's contra to the market. So people always try to travel in packs. They're insecure. They need confirmation from other traders, but that's not the style that I do. I know I like to trade against that type of style, that emotion.
Okay, very good, very good. So this is something we were also talking about a little bit off air, and that's traders talking about other traders. So I think you've got some sort of thoughts to share on that statement there.
I do, and what I think is, I left the corporate world 10 years ago, and I don't regret it for 1 second. I hated everything about the corporate world. And what I've noticed is, especially after the past few years, is that, I use Twitter, not a lot, but, I've used it for the past 5 years. And what I noticed is that Twitter traders love to talk about what everybody else is doing, whether they're in a position, whether they're out of position, how much money they're making, what they're saying. It's literally like working at a corporation and hearing the chitter chatter about your coworkers. I mean, I think it's completely bullshit, because if you're concentrating on somebody else and what they're doing, you're never going to make any money. Why do one other person's profit and loss statement makes effect on yours? It makes no sense to me. And why someone would hate on somebody else and troll on somebody else when they make a trade or say something, who cares? I mean, I know this is a business and people sell things on Twitter, but the bickering, I can't take it. Like, I had to cut a lot of traders out of my life because all they do is talk about other traders. I mean, I think it's lame.
Yeah, no doubt, no doubt.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So, moving along, what do you believe is the main reason why such a large majority of traders never succeed in this game?
Because it all goes back to the mental aspect. People do not understand that people's flaws in life, about being insecure or about not being humble and needing confirmation from other people and needing support. People do not understand that applies to trading. And all because the group is thinking one way, that doesn't mean the group is right. So mentally, what happens is that when say a group trade goes wrong and someone loses money, especially a new trader, they always try to then chase the money back and make the money back. It doesn't work that way. So that's why a lot of traders fail, because they're getting confirmation from other people and they're not doing the research themselves and the homework themselves. I mean, the most profitable product on Twitter is alert services. And what that tells you everything you need to know about where trading is going for the next few years. It's been like this for 2 to 3 years now, where people just want to know what to buy, no questions asked. And those people are truthfully not making any money. There's only a few people that are making money, even in today's market, because they're overtrading. They're not doing the research themselves. And, you know, if you want to learn how to fish, I mean, someone needs to teach you how to fish. And in order to do that, you need to do research and homework on why somebody is buying and not just do it and follow someone blindly because they made a good call two months ago. So that's why I think a majority of people fail, because they're too busy in that groupthink and the mental aspect of trading.
Yeah, I think those are some really good points you brought up there. So yeah, thanks for sharing those. Now let's just sort of start to wrap this interview up. So we'll just sort of go to the closing, Bill, and this is just a few questions that I asked to a majority of the guests. Is there any recommended reading that you would suggest to someone, perhaps something around the topic of psychology?
I haven't read many trading books myself. I don't know of any good books out there currently. There probably is some good stuff on trading psychology now, but I'm not up to date on the reading of it. I try on my Twitter to put out as many articles as I can about trading psychology, because, you know, I love the world of finance. So I'm always trying to do something free and give back to the world of finance. So that's what I try to cover. But I guarantee you nowadays there's probably some good books out there, but I don't know of any.
Yeah, that's cool. So you've learned most of it from just sort of being in the trenches, right?
That's correct.
Good stuff. So when it all comes down to it, what would you say motivates you to trade after sort of 10 years in the game? Is it the money that you can make from trading? Is it the lifestyle it provides? Is it the freedom? Like, what would you put it down to? Well,
the money's nice. I mean, the money's great. And, you know, obviously we all want to make money. That's why we're in the business for this, why we're in this business. But, I mean, you cannot put a price tag on your freedom from the corporation in a cubicle and having to work for other people that you do not like, and other coworkers that you do not respect. The independence is just such a massive key. I mean, that's all everyone who always reaches out to me for trading advice. They're like, they want to be independent. They want to be free from a corporation. I mean, trading is awesome. I mean, there's days where, especially after tough losses where, trading sucks. But I don't let myself get too down on those days. I try, once again, to keep the steady emotion. I love getting up. It's weird. Like, my family friends and, my son's friends in the neighborhood, they don't know what I do for work. They don't know that I'm a stock trader. A lot of them, I think I'm homeless because I never talk about what I do. Because when it comes for trading, that's just something that I like to do. I even use a phony name as a trader because back then I never really wanted to brag about how much money I made. So it's something, if you're independent and you're tired of the corporate world and you do the research and tools, I recommend that trading is for you. I mean, everybody wants to do it, but no one wants to put in the correct time. Or a lot of people don't want to put in the correct time. I should say that.
Yeah, so important, so important. So in there you talked about days that just really suck. So say you have a really bad day one day, how do you treat the next day? Do you just come back to it treat it as a fresh slate, or is there ever a point where you decide not to trade for a day?
Yep. What I've learned is due to my degenerate gambler tendencies is that when I have a bad trade, like a 5-figure loss in the morning, I shut off my computer and I don't trade anymore. Because the reason why is what I try to do is make trades, or I used to do, the old Welsh 5 to 10 years ago when he was first starting out full-time in his game. I would try to make that money back as quickly as possible. And stats show me, because I keep a personal journal of all my trades, and I analyze them. And what that showed me is that whenever I tried to make my money back quickly, I would lose it. I lose more. So the most profitable thing that I can do when I have a losing trade, especially an unexpected one, is turn off the computer, and I honor that. I turn it off, and then I come back the next day like nothing happened. And even that day when I lose money, my wife can't tell whether I make or lose money. Because one, when I'm making money, I sure as hell don't want to tell her because she's going to be spending it. And when I'm losing money, I don't want to bring my family down. I like to keep my business separate than family because I trade in the same house. I don't like the mood to overcome the house.
That's great. That's excellent. So just one other thing that you touched on there, and that was documenting your trades. How do you actually journal those? Is it sort of a written notebook, or do you keep how do you go about that? Is there a file on your computer? How do you journal your trades?
I journal even to this day, I journal I have an Excel spreadsheet. And basically all it is, I put down the day, when I make the trade, how much shares that I trade as percentage to my balance, and, whether it's short or long. Every day, either during the day or end of the day, I fill out the spreadsheet, regardless of whether I win or lose. And I put in the correct amounts, and I keep it as my personal, second pair of eyes. Because being a trader, is really a lonely business. I do have trader friends, but, no one, when you're in a bad streak, no one really likes to talk about it. I like to talk about it a lot, but I know when I've lost friends over the last few years that just completely dropped out, probably because they were losing so much money, some trader friends. So I use that Excel spreadsheet as my accountability. If I'm doing things stupid, I want to see it on that Excel spreadsheet. I want to look at it. I want to see it every day when I do something wrong. And guess what? When I'm doing something right, I want to see it. I want to press harder, and I want to go bigger in size, and I want to make money. And that spreadsheet, I mean, it's sad to say, but I need it, and I keep it, and I've been doing it for so long. It's just second nature for me. So that's like my second pair of eyes.
That's really good. I mean, if you find something that works, you just keep doing it, right?
Right. I mean, I love to ditch it, but I'm afraid what would happen if I did?
I think it's more important to be making money. So if it's helping with that, stick with it, I say. So this has been awesome, John. Thanks so much for coming on. I really appreciate you taking the time on a Sunday evening. Before we go, do you want to share with listeners where they can find out more about you and connect?
Yeah, just you can go on Twitter at John Welsh Trades. That's it. And some days I hop on, I give some trade ideas and some commentary. I try to do when I can and give back for free, whatever I can for finance. And you can see me there. And I'll try to tweet quality stuff whenever I can.
That link will be in the show note to John's Twitter page. Go along, follow him. And yeah, thanks a lot, John. Let's keep in touch and we'll speak soon.
Aaron, thanks again for the opportunity. Have a good weekend, or in your case, have a good week.
No problem, man. Talk soon.
Take it easy. Bye-bye.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time.
you and more about your book and that type of thing, and then we'll leave it at that.
Sure, thank you. Probably I'll just give you 2 URLs. My book you can find at tradinginanutshell.com. That's all one word, tradinginanutshell. Or my website, yet to be developed, stuartmcphee.com.
Okay, awesome. All right, we'll put those links in the show notes, and we'll keep in touch. Thanks
Terrific.
again, Stuart. Interview at chatwithtraders.com/Adam. So if you just go there, you can find links to everything you mentioned. And
Chat with Traders is brought to you by Trade the Pool. Did you know?
As a discretionary trader for many years, but with an urge to optimize his trading approach, he gradually transitioned into a quantitative trader and went searching for new ways to exploit opportunities within the market. From there, David has gone on to take out the #1 spot of Battlefin's Sharp Ratio Shootout, an international quantitative finance tournament with over 3,000 competitors. During our interview, David brings a really insightful take to topics such as the transition from discretionary to quantitative trading, how to eliminate a single point of failure by trading multiple systems, and how the Monte Carlo tool can teach you a lot about how robust your strategy really is. And I must give a special mention to Zach Hurwitz, who was the guest on episode 11, for making the intro to Dave. So thanks a lot, Zach. I appreciate it, man. All right, guys, I'm Aaron Fifield, host of Chat with Traders. Here is this week's guest, David Bush. Dave, what's up, man? How you going?
Doing great. Good to speak with you, Aaron.
Likewise, thanks so much for coming on the show. It's great to be speaking with you, the Battlefin champion.
A Battlefin champion. there are a few at this point, but yeah, I was probably number 4. That might be right. I'm not sure about that, but yeah, it's certainly that's been a great relationship and fun experience.
Nice. What was the category you took out then?
Let's see. if I recollect correctly, there were, I think in the email, there were 3,200 applicants from 41 countries, or a bit more than that applicants wise. But they chose, I think it was 9 or 10 strategies in 3 different divisions. I couldn't speak to everything about the divisions, but one division had an audited track record, one simply a live track record, one might have been just back-tested results, and I had a live track record and verified or audited results. So I was in that so-called elite category, and I think the strategies also, if I remember correctly, were across broad asset classes. So it was not like equities were in one bucket and futures were in another, and so on and so forth. I think I'm right about that. At any rate, they had a proprietary formula, and which took volatility into account. So in other words, it wasn't just a return-based type of formula, which is flawed in the sense of one can just juice a strategy for a tournament or something like that. So that I don't believe that was anyone's approach, anyways. But that was the gist of it at a high level.
Yeah, very cool. Well done. So let's get this started by giving us sort of a bit of an intro about yourself. So take us back to where it all began for you, and tell us how you discovered trading and what were you doing at the time.
Yeah, that's a lot to talk about there, and I'm sure everyone's story is probably different in the details, but similar in the sense of a lot to talk about at the early stages. What I was doing at the time was I was a professional musician. I had been for a number of years. I got started playing very early. In grammar school, I guess. I took to it very deeply. After a couple of years, I wouldn't say I was bitten by the music bug immediately, but after a couple of years, I started playing drum set. That's ultimately what I played professionally, and that it just took over. And as I look back, music and markets are both pattern driven. They're both cyclical. One has to tune in. You have to tune in as a musician to those around you. Literally, if you're playing a pitch instrument, to pitch, obviously drums to groove and tempo, dynamic, on and on. There are many layers that are happening simultaneously. Markets are very similar, and they both are, they both have that behavioral component. Markets are certainly not the same in terms of investor sentiment and behavior from, year to year, day to day, whatever. So anyways, to answer your question about, how we got into this, I'm working essentially, in the evenings, and at night, and occasionally, obviously, rehearsing during the day. But days were, largely free. And, I don't remember the exact initial trigger, but I believe it was I believe I was at my father's house, and he might have had CNBC on, in the very early days. This would have been 1994, early 1995, but this probably would have been 1994 before I started trading, which was in 95. And I remember probably on CNBC, possibly Bloomberg, seeing a piece or, some kind of interview, and whoever was being interviewed talked about the market. He said, valuation can change overnight. Yesterday's close can be dramatically different from tomorrow's open based on just market crowd sentiment, however you want to phrase it. And for whatever reason, that just fascinated me. And plus the ticker, the scrolling ticker, which is not something that I use at all, unless it's some kind of watch capacity, which is uncommon for me. That fascinated me. I knew that there were patterns in there. Obviously, you could just visually see some patterns. And then also, obviously I knew there was opportunity in there. And, I was, I'm not shy about saying after all my training, I was a very, very good musician. I played, at a high level and so on. But it wasn't the most fruitful, career monetarily, at least, in my years, as a professional. So, there was a perfect opportunity to look at something new and, see if I was really interested and see if I could do it. So that was the genesis of the idea. From there, it was really starting to pick out some books, go to the bookstore. There were a lot of futures books at that time, which is interesting because there are not as many when I go to a bookstore now, physical bricks and mortar bookstore, but there were just tons of Larry Williams books and so forth. But, ultimately it was stock that I started trading, and, it was actually, picking up Investors Daily and seeing charts and going, oh, okay, charts, these are interesting, and that led me into, investigating, what technical analysis was. So that really is, I probably missed some part of your question there, Aaron, but, that was really the very early stage.
Yeah, that's excellent. So, I obviously wasn't trading around that point in time. So I believe this was before electronic trading sort of really came in. So talk to us about how you were maybe receiving data at the time and analysing the market and sort of placing trades. I believe it sort of involved a fax machine of some sort.
Well, right. And it's funny now, to me anyways. It did, the fax machine was later on. That was an incredible upgrade, actually. What it first began was the newspaper, literally, reading stock tables, Barron's Investors Business Daily. But I quickly learned through Investors Business Daily that they had a service at the time, and they probably still have it now electronically, but back then, to me, it was an amazing service because it was called Daily Graphs, and you could get this graph book sent, produced after Friday's close, after, north of the city and, kind of remote in a sense. This chart book would show up on Saturday mornings, or, this stock had gone up, this had gone down, whatever. But, it was very crude, and yet it was definitely formative. And my first trade was based off of, off of what I knew to look for, which was limited, but was based off of chart pattern. And I think it was that very first trade, I'm almost sure, which was Xylogix, XLGX. I'm almost sure of that without digging through ancient trade confirms. That was my first trade, and I got woken up. I didn't have data coming in. I did not have any kind of active real-time anything. So I got woken up by my broker, and he was a full-service broker, and I probably placed about 2 trades with him when I realized the cost of them, which was, I think, maybe a couple $100 a trade back then. I realized that was insane. But he woke me up one morning, actually, pretty early before the market was opening, and he said, "Hey, it's Charlie. You making money in your sleep?" And I don't know whether I was asleep or whether I just was not quite up and running, but I do remember answering the phone and listening to this and going, what the heck is he talking about? And that stock had been taken over, 2 or 3 weeks after I had placed a trade. So that was, in hindsight, probably like the worst thing that could happen to me, because here you've got this process that looks incredibly easy, right? You just get a chart book, you pick what you think's the best. It gets taken over for, whatever percent gain it was, probably, somewhere between 30, 40, 50, 60. I don't think it was as high as 60, but it was probably in the 40 or 50% gap up range, something like that. At any rate, above my entry. And, that was the first trade. And, from there it was a hard slog, basically, speeding up my path a little bit. I did get trading quotes. That was the beginning of some pain for me, because while I was looking at charts initially, I got quotes, but the quotes didn't have charts, and the quotes came through cable. So you had to have a cable connection. They came into a little box that, God forbid, if it ever got unplugged, it took about 2 hours to reload that box, the OS. But anyways, I got quotes. So now I had quotes, no charts, and I started, trying to trade based on that. I had some success, some obviously some losses, but it was very. I was, as people will say when they're new at something powerful. I was most dangerous to myself. I had a loaded weapon, and I was. Constantly, it was constantly pointed at myself. I ultimately placed a lot of trades, went away to play music for a couple weeks, and the market had a very normal pullback. This was now in 1996, and I basically, not watching charts, just working off of quotes. I lost a lot of money. In fact, the screen every morning, I would just look at the screen, and of course, in a pullback that's broad, the screen is essentially red. There might be a few defensive names that are green, at the top if you have it sorted that way. But basically, day after day, the market was just pulling back broadly, everything highly correlated, my stocks all going down. And eventually, I was getting very afraid. And you have to remember, I knew almost nothing. I was completely self-taught, had some success, but this was my first real pain moment. And, I said, if this happens, if the market is down again tomorrow, I'm going to sell it. I can't take it. And I remember that next day, it opened, timidly, maybe a little bit higher, and then the market just sold off, and it was an absolute knife twist bottom. I sold out of everything. Market reversed, ended up positively. That was, the bottom for probably months. Actually, it was the classic reactionary trader psychology, and that was when that was my gut check moment where it was okay. Am I going to really do this? Am I serious about this? Because clearly I'm not equipped to do this properly, and in terms of education, in terms of equipment, anything. And I'm not one to give up easily, so I just buckled down, and that's when I started really reading. That's when I started. I had an aha moment of, every trade needs a plan, every, risk needs to be defined. I mean, really, it's so basic. However, that was the beginning of really becoming a trader was that first, large, painful loss, account drawdown and then going, all right, what am I going to do about this?
Okay, so from that point, where were you learning from? Did you land a mentor, or did you continue to teach yourself, like through books and study, etc.?
Yeah, up to that point, it had been exactly that. But then comes the fax machine. I started subscribing to a couple of newsletters. This was, this was still before email, or at least any widely spread email. I'm sure some governments were in some early. Had some early iterations and so forth. But, so I got a fax service. I got a fax machine. I started subscribing to some fax services, and they were just daily trading sheets. I'm doing this, I'm doing that. Here's my stop. Here's our target. Here's the kind of order. Very basic. So I subscribed to a couple of those, or at least trialed them. I subscribed to one of them. And, after a couple months, I called the guys up. I said, hey, I'm not that far from you. Can I come in? I'm a subscriber. Can I just see your operation? And, they said, all right, come on in. And it was a couple guys with a secretary, a money management business, but also that was just making a little, small foray into education. And essentially it became no one ever used the word internship, but it essentially became an internship where I was able to just, help them around the office, do this and that odd, job, whatever. And meanwhile, I was often behind them, listening to them talk about the markets, listening to them look for opportunity, place trades, whatever. And I started to, obviously, I picked that up.
Okay, excellent. So give us a bit of an overview of sort of your trading approach and sort of the method that you've adapted today and sort of how you navigate the markets.
Sure. It's certainly evolved. My early trading, once I had education, once I had really a couple mentors clarifying things for me, showing me subtleties of patterns, showing me, how to get a deeper insight into a daily chart, for instance, by looking intraday and lowering risk and so on. It really was discretionary, technical trading, trading primarily on a swing time frame. So looking for, that kind of 2 or 3 day to 1 or 2 week type of trades. So working typically off, daily chart, but looking at various time frames. And trading larger concentrated positions. They might be, 20, 30, sometimes greater percent of the account, which is something I don't do anything resembling that now. But at the time, that is how I started. Flash to the present day, which is 20 years later, not quite to the month, but in a few months it will be. And I have a couple strategies. I'll still play some discretionary trades, certainly, but my primary activity is quantitative, and I have a flagship strategy, one that's been live for over 4 years, and has an extensive back test with, survivorship bias-free data and much more that I could speak to. But that is, that's my primary strategy. That is very similar in a sense to my early trading style, but it's quantified. All the positions are typically small. There are no concentrated positions. Nothing ever over 10%, and in fact the max is lower than that, and the typical position is much lower than that. So it really, I see the evolution of my trading as, managing a trade or a few trades at a time to managing strategies. The strategy I just spoke to, another strategy that is in the final stages of development is also quantitative, but it's very different. It's a machine learning based strategy. It will be up to, this remains to be seen, but somewhere between 30 and 50, most likely, strategies or systems rather, all running together as a meta system, under one strategy. So that's yet another thing, and that'll be primarily intraday. But bottom line, now I'm really the manager of strategies. The trades themselves are less significant. Obviously, they're important that overall they work, but it's really making sure that the risk controls are in place and are working, that the live trading is in line with the back test. There's lots of ways to back test poorly. So, that's probably more than you asked for, Aaron, but that's, the kind of the quick evolution of my trading.
Yeah, that's excellent. And I want to sort of get into that a little bit deeper. But before we do, if you were to give sort of a discretionary trader an overview of quantitative trading, how would you actually sort of explain this, just if we can be clear on this before we sort of get too much deeper into it?
Sure. Well, it's a great question, and deserves probably a compact, elegant answer. And let me try to do that in a second. This might be helpful because I was that discretionary trader. And why did I get into quantitative trading? It's because I had this question, which was, I'm in a trade, right? And I've entered this trade as a discretionary trader. What does that mean? It means that I'm using charts. I'm trading on principles, right? I'm trading this trade because volatility contracted, and there were narrow range bars. The trend was clear, whether up or down. on and on and on. Bunch of principles that, formed enough of a case. They built enough of a case to justify this trade. But now I'm in it, and I know my risk and so forth, and I'm hip to proper position sizing, of which there are many approaches. But what I never knew the answer to was, what I was always asking was, what's the optimal exit? Like when should I get out? Is it when I feel like getting out? Or so there's so many behavioral biases that work against the discretionary trader or your average discretionary trader. Your fantastic discretionary trader can overcome all or most of these biases of not selling too soon and not holding on to the loser, the disposition effect, and all these kinds of things. But bottom line, I knew that there had to be, based on my approach, if I made those, conditions, if I made them rules, there must be an optimal exit. Even if the exit evolved later on or was a little bit different in the past, right at this moment, there probably was an optimal exit and I didn't know it. So that was the germ or the seed that was planted that that I carried for a while without doing anything about it. But ultimately I did make the move into finally getting over my fear of learning to code and diving in. So I certainly can speak to any of that more. But in terms of the benefits of quantitative trading, one can really aim to be optimal, or at least near optimal. That's how I think of it, rather than trading suboptimal. I mean, whatever area of business you look at, or let's take conservation, for example. Let's say a company is trying to shave expenses and whatnot. Efficiency is really is almost like the go-to area. How can we be more efficient? UPS drivers. I think somebody was telling me about a report where UPS was able, through efficient data analysis, shave something like 30 million miles off their drivers' routes in a recent year. I mean, don't quote me on that, but that's the idea. So, as a discretionary trader, you have to be left wondering, what could I be doing better? What's the optimal exit? Maybe this pattern, this reversion pattern, this pullback would have been better entered, 1% lower. These are the kind of things that you just never are going to know as a discretionary trader. Whereas a quantitative trader, you can know, and then you have to, of course, be sensitive to, do you really believe in your back test? Is it significant? Is it statistically significant? So that's another area of, there are a lot of pitfalls to becoming a quantitative trader if you don't do it right. That's the gist of it, in my opinion.
Okay, awesome. Thanks for breaking that down, David.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So, what were some of the first steps you actually took in transitioning to a systematic sort of / quantitative trader?
Right. The first step, I believe, was having a huge list of things I wanted to test. So, as an often pattern-based trader, there were a lot of patterns, whether it was, a technical, triangle pattern, symmetrical or ascending or descending. Obviously, I wanted to have conditions that surrounded that. So I just started, obviously taking my discretionary approach and putting it into a list, which essentially were conditions. I mean, I don't think I would have called it that when I was creating that list, but I put these conditions in a list, and and then I found somebody who was willing to help me code up just kind of like a master template, and that was invaluable. So that was really the first foray was having somebody on the other side of the bridge code this up for me, at a pretty reasonable rate, and and then give it back to me, and with a couple notes, and then I was off, and it was just a matter of of starting to experiment, and I certainly did not have any great testing process at that point. I was smart enough to use out of sample data. That's a big thing. So I don't want to go all into those proper testing procedure, but that's what I started to learn next. Apart from the coding, I had a head start on the code itself, at least in that first program, but from there it was really, how many rules, how many data points should I have? How many rules do I have? Do I have too many rules over too little data? These kinds of things you start to learn. And, I started to read about trend followers, even though I'm equities, and one strategy is reversionary for the most part. Another strategy is quite varied. But futures trend followers are really some of the earliest systematic, programmatic, quantitative traders. And I started really reading about them and reading about the turtles and, really just the history of that early generation of systematic traders, many of whom, could write their systems on the back of a napkin, simple.
Okay, sure. So I don't know if this question may be sort of beyond the depth of this interview, but you mentioned earlier that you were sort of looking for your optimal exit, right? So what sort of process did you actually go through to discover the most optimal position to place stops for your actual trading method?
Right. Well, it's funny. It's a great question. And stops are one thing that, of course, as a discretionary trader trading larger concentrated positions, I found were getting in the way of some of the best edges. I started to create a bunch of edges, a bunch of systems that most of which I did not ultimately keep. The best of which did end up in my meta system, which I still trade. But stops were something that when I traded a lot of positions with very small size, I got rid of, because often at least with my systems, the greatest probability of a reversion would happen essentially, at the stop at the stop point. So that's something that would be easier to see with some data. But in terms of how I determine the optimal exits, in forgetting about stops for a moment, just simply let's say a limit exit, or even any ways you could think of a swing style exit, whether it was end days later, end bars later. Various exit styles based on indicators, on and on, pattern-based exits, and certainly I tested stop-based exit too, trails and whatnot. But I would say the process of finding that optimal exit was really just testing all of them, and you find out early on as you get into quantifying trading that and systems and edges and so forth, that you absolutely need to be incredibly organized with your record keeping of results, because you don't want to just constantly change indicator values, and not keep track of what you're really learning. You're not going to learn enough as you combine multiple conditions together. If you don't understand each one separately and how it's starting to interrelate with the other, you're going to be lost as you try to quantify. So it was really breaking down entries with a dumb exit, a so-called naive exit. I would, even in my code, I would call it dumb exit. I would comment out some text that wouldn't be active code, but that's what they were called, dumb exits. So I would trade, I would test entries over dumb exits. I would trade exits over random entries. Randomly generate an entry. Let's say day one has a bar. In that low value and high value, the whole range of that bar, any point on that bar, for instance, could be an entry, and that's a random entry test, or one iteration of a random entry test. So, just basically to be more simple in answering your question, testing things separately, keeping good records, and finding out, at least based on the ideas that I was testing, what really was optimal. And it was typically a shorter hold time than I had anticipated. I had anticipated that actually with my approach, a longer hold time, just some number of days more, was probably going to be a boon. It was going to be superior. But actually a shorter time, a hold time was typically superior, in my findings and, in my approach. So it was illuminating. It was very, some cherished notions tested well. Other cherished notions had to be tossed into the fire.
Sure. That's really good, Dave. So now that you are sort of, pretty much 100% a quantitative trader, what would you say this has allowed you to do that you couldn't do previously as a discretionary trader? Like, has it freed up sort of more time? Are there any sort of benefits in that regards?
There are a lot of benefits. I would say, time was not the first one that came to mind, but that is one. Geometric sizing. While I, as a discretionary trader, was familiar with position sizing and had read all the latest and greatest, research and so forth, had built risk calcs and so on, I still did not feel like I was managing my capital as efficiently as I could. Whereas once I was quantitative, I have, a set of code for the signals, all aspects of the signals, which I could go into deeply, but there's another set of code that's just the position sizing and risk management controls. So really being able to control these and study them ahead of risking $1 with this new approach was fantastic. So I would say time is a benefit in the sense that, I am not, the discretionary traders, have that twofold job of, well, there's during the daytime, you're working during the daytime often, even if you're not actively trading major decisions, you're typically monitoring things, maybe looking for other things, and then the market's closing, your day begins all over again with looking for opportunities and watch lists and alarms and on and on and on. So that process is incredibly streamlined now, where it's really literally collecting more data and pressing some buttons and and then I have a flat file I can upload the next day, or I can simply in another strategy simply deploy. No order uploads necessary. It's going to be interactive throughout the day. So, I'd say time is a benefit. Another benefit is risk in the sense of being able to study all of these systems, together. I do believe in multiple systems. You eliminate any single point of failure. That's crucial. So multiple systems together. Some people will say that is the that is the one free lunch. A form of diversification in the market. What was I going to say about that? Basically, being able to study the interactions of those systems from a risk level. In other words, and you can do this as a discretionary trader as well. If you have enough historical trades, you can look at all your trades and you can input them into some Monte Carlo program. And essentially, Monte Carlo is going to give you alternate trade histories based on those trades, but randomizing them into a different order. And there are some versions of Monte Carlo where you can add substitutions that are statistically similar, and there are all sorts of variations. But the bottom line is Monte Carlo analysis allows you to look at your strategy, whether it's real trades historically or hypothetical trades, and scramble them all up, look at alternate trade histories, and you see not one theoretical equity curve or one historical equity curve, but you see many. You can see, 2,000, 2,500, 5,000, 10,000 if you want to go just absolutely nuts with the Monte Carlo. And you can learn a lot about your approach. And you can learn that, wow, actually, let's say it's historical trades. I might have had a drawdown. This is just a hypothetical example. I might have had a drawdown of, 15%, during the, last X number of years I was trading the strategy. Well, you do Monte Carlo, you might realize that you have actually you have a 95% confidence of a 40% drawdown, that you didn't know about, because Monte Carlo analysis shows you that if your trades in the future are statistically similar to the trades in the past, then you might be assuming more risk than you knew about. So that's just a beautiful thing about quantifying trading, is that you can look at a risk level and you can say, okay, what should my position sizing be? What should my approach be if I want my max drawdown, my max expected drawdown to be no more than, let's say, 15%, in all of those trade histories, 100% confidence level, or 95% confidence level. So one in 20 years, I might get a drawdown that bad or possibly worse. I mean, so the benefits are so numerous. And quite frankly, I love data. This is already being called the decade of data, and we're only halfway through it. And people came up with that term a couple of years ago, at least, I'm sure, probably earlier than that. But, this is an incredibly, I think this is the beginning. This is an incredibly fertile time in terms of data markets, data streams that are becoming standardized and usable as a trader. So I'm really glad that I did make that switch. It's not that there's any flaw with discretionary trading. I will still, like I said, occasionally make a discretionary trade, something that I don't have quantified perhaps, but I see the opportunity and it's very compelling and I like the risk. However, there's just so much that I want to do, in terms of quantification with financial data and sentiment data and so on.
Yeah, there were so many good points that you brought up there, David. So that was really good. Obviously, a good system or a strategy is one that is robust. So, how do you actually determine whether or not a strategy is robust?
Right. It's a great word. I would say that statistical significance is really the test that it must pass. A high information ratio. They're really metrics. So let me give an example of a couple. First of all, there are some trading systems that people have, or systems where I've seen in books, people write a book about trading systems, and they'll include some systems, and maybe they, in a couple cases they'll have a system that they put out there, and it has 100 trades historically. It has a number of rules, and there's no mention of statistical significance. That's important. There needs to be, in any good system, in my opinion, a lot of degrees of freedom. So in other words, the number of data points, number of trades, compared to the number of rules embedded in the system, all the conditions, all the decisions from entry to exit, and so on. There have to be mostly degrees of freedom. There cannot be too many rules. So a robust system will be statistically significant at a very high confidence interval. And there are programs that will enable you to do that within the software, or you can just do that within Excel. I mean, there are a lot of ways to do that. Certainly, there's plenty of literature on that. Another aspect to a good system, a robust system, is, there's so many. I would say ability to translate to other tradables. So, it should work across not necessarily a lot of asset classes. I'm not one who says that, this equity strategy should work on energy futures, because there are a lot of structural differences, a lot of differences between the business of money management of equities and the institutional sponsorship and demand that can drive reversionary strategies in equities, whereas that doesn't exist in the same way in various commodity markets. But I do think, let's say within equities, a good system or a great system, a robust system, should work across most equities of the same class. Most mega caps. A strategy should be significant across them. Another aspect which might be too obscure, Aaron, so you can shut me up if you need to, but survivorship bias is something that the quantitative trader has to face. In other words, if you're developing an equity strategy across stocks and you are testing across today's S&P 500 index components, those 500 stocks that exist in the index today, and thinking that historically that's what you would have been trading, that is just not even close to the case. Where's Lehman Brothers? Well, it's not going to be in today's S&P 500. Where's Enron? It's not there. Where's WorldCom? So you have to know, as an equities quant trader, where are the tickers that live in infamy? Those are delisted. And so if you really want to go the extra mile, and in fact, there was a point, kind of another gut check point, when I was developing one of my flagship strategy, one of my early meta systems, where I said, what would Steve Jobs do? Would he go, it's time to build a survivorship bias-free database, because that's going to give me more information. And the answer, in my head anyways, was, well, of course he would. He's a perfectionist. He's going to want to know the absolute best approach to building this product, this strategy, and therefore go the extra mile. And so that was one of those things I did. Not from the very beginning. I developed a strategy, and then I said, you know what? I don't believe it enough until I add in the blowups. I add in the Enrons and the WorldComs, or the shorts that might have been taken over, acquired and gapped way up that aren't in the index anymore. So, that's to me another real key for an equities trader to consider and hopefully test across. Are those delisted symbols. And I'll tell you, that's a real pain in the butt because if you're really going to do it to the daily level or even beyond, but certainly let's just say the daily level, you do need to know what are the constituents on any given day. April 3rd, 1997, if that was a business day, what's in the index that day? Well, it might not be the same the next day. So that's quite a process to put something like that together. But I think worth it. And, yet another way to ensure that you have a robust system.
Yeah, again, that was a really good point you brought up there. I was actually going to ask you about survivorship bias. So yeah, that was good that you mentioned it. Have you ever come across a situation where sort of trading a particular strategy live performed nothing like the results it produced when going through your back testing process?
Happily, the answer to that is mostly no. In fact, it's a more recent phenomenon of not having had that experience. Happily, really having my my performance live be what I expected in the from the back test. However, when I have altered execution, even after study, I have found that's an area where where the live results have not emulated the back test to the to the degree I like. So that's something that when I experience that, I have to take that offline, revert back to the original proven methodology for execution, and then and then go to the woodshed on what I was experiencing with the change. So there can be some surprises like that. I'm certainly not immune to them, but happily, I took really 2 years to develop my strategy, which included many systems together, the Stratversify strategy, and that when I rolled that out, it was really after about a 2-year process. So I try to look at I tried to see every facet of that diamond, if you will. And, once I rolled it out, I was happy with how it performed. It brings up the point though of how does one measure, performance, with a quantitative strategy. And, that is something that, traders will differ on, in terms of, how best to manage a strategy. Obviously depends on the strategy and the nature of the strategy. And it could be as simple as having sliding time windows for something like winning percentage. If you see that your winning percentage is dramatically different by some standard deviation from your expected winning percentage over a certain number of trades within a certain time window, that could be something to examine. So having some kind of dashboard, some kind of method at least for checking your system health, that's important as a quantitative trader, rather than assuming, hey, it's worked, so it's always going to work.
Yeah, too right. So that's really great. Another topic I'd like to bring up with you, and that is fractal patterns. Now, I don't know too much about fractals, but I believe it's something that might be relevant to your trading. So would you be able to explain this a little bit, sort of about what this is and how it's relevant?
Yeah, that's a huge question. It's a fun question. I am no fractal expert, but I take inspiration from those who are those experts. In fact, one of my favorite quotes is from the late mathematician Mandelbrot, who said that bottomless wonders spring from simple rules repeated without end. And I can imagine, I don't know actually the context in which he stated that, but I can imagine if it was a lecture that, he was displaying, his one of his fractal sets, or, looking at a coastline, and expanding, and you go closer in on the coastline and it keeps getting longer. You cannot quite measure it because it just keeps growing, but nevertheless, the patterns are repeating almost on, from any perspective, from any dimension. So certainly in trading, whether one's a discretionary or quantitative trader, I mean, in fact, as a discretionary trader, you start to see that. You say, oh, well, look at this weekly pattern. Gosh, I've seen that on the daily charts before, and then you look intraday and you say, well, gosh, here's that same pattern. If I did not have, date levels at the bottom of my chart, if I did not have, year markers separating, this year from that year on this large time frame, I might think this is an intraday chart. So there is a definite, widely recognized fractal nature to patterns, in markets, and in terms of my own, my own coding and so forth. That is something that is, largely, it's a great interest to me. Lots of books on the subject. As you might tell, I love my trading books, and I try to read far outside of just trading. Which this would be one of those subjects that applies in so many fields, disciplines, and so on. But that's something that I am. It's kind of in. I wouldn't even call it development phase. It's more the woodshed type of phrase. That's an expression from my music days. If you hear some, great musician playing something and you go, wow, I cannot do that. What is that? You go lock yourself in the woodshed, and you stay there until you figure it out. And then you methodically work on it over time till you get it. So, fractals and incorporating fractals beyond my conceptual understanding, and certain aspects which maybe they're already coded to some degree. That's something that's kind of in the woodshed. I do expect to maybe have a production strategy that is largely based primarily on some fractal formulas as the key driver.
Okay, great. Yeah, that's a really good answer. So again, Dave, thanks very much. But now I couldn't have you on without asking you about a quote that Zach Hurwitz mentioned on episode 11, which he learned directly from you. And that was the eagle, the donkey, and the mouse, or the concept of those three things.
Right.
So would you like to talk us through what this actually means and how you've used that to view trading?
Well, that's funny. I love Zach and certainly respect his his approach and unique ideas so much. In terms of that quote, it's funny. That is, I believe, from an older interview I did with the Tab Group, Quant Forum, and. I was probably speaking off the cuff. I'll tell you how I relate to that, though, which is certainly as a trader, whether, or this could apply to anything, running a business. But certainly as a trader, I think you have to be all of these things, right? I mean, as a quantitative trader, for example, you have to have the vision. You have to have that perspective, that high, eagle-like vantage point where you're looking at markets and you bring some kind of concept, to, let's say, your coding, and that is in one sense, being the eagle, is having that vision of what your strategy might look like.